Hello, this is Minder Chen. Thank you to come back to the entrepreneurship course, and today's topic is market sizing. It's a continuation of the discussion of the general concept market sizing, and in this session we're going to do some real calculation and show you some example of how to size your market. And the market size is an estimation of total number sold or service rendered in a particular segment of the market. And the market size can be measured by, for instance, number of units sold. And certainly it can be measured by the total dollar amount involved. And certainly if you know the price of your product and you know the number of units sold, you can calculate the dollar amount. And the size of a market is usually based on the annual sales. So the time frame is usually 1 year. And you can certainly calculate the market size based on your market segments that you target. Sometimes we use NAICS, which is a North American Industry Classification System, to identify the market that we try to address. For instance, there's so-called a manufacturing sector, but it can be further broken down to, for instance, the shoes manufacturing. And the shoes manufacturing can be further broken down into, say, men's shoes, women's shoes, or sports shoes, etc. So we talk about market segmentation. So this is where you need to have a clear idea of the market segment that you try to address in a particular industry. And sometimes it's like what kind of consumer that you try to address that could be slightly different. We can estimate the market size through a top-down approach or bottom-up approach. We're going to start with the top-down approach. And the top-down approach is calculated by just calculating the total market, then the estimate the share of the market that you try to grab from this total size of the market. So you started with some broad statistic, overall population, household, and total sales of certain product in the industry, etc. And you can usually obtain this broad statistic from some secondary resources, industry-specific reports, etc. And market research report. And eventually you can derive the total market size. And sometimes we call this total available market, and which has an acronym called TAM. However, the total available market is the biggest pie and that you can grab. As a startup company, you do want to narrow your target on such that you can be more focused. And so let's go over some of the terminology which are important. However, this terminology, the way it's spelled out, such as TAM, SAM, and SOM, are quite different. Depends on who is actually you're referring to. So TAM is a total available market, and sometimes it's called total addressable market. That's the biggest part, the total revenue opportunity for product or services. And the smaller next level is called SAM, which usually it's called served addressable market, and sometimes people call it serviceable addressable market, which is a segment of the TAM, the segment of this bigger pie that you target by your product. Remember we talk about market segments and market targeting and eventually product positioning. So this is where the market targeting that we referred to earlier. So it is the TAM that you target. So it's a percentage of the TAM which would end up to be served at an available market called SAM. An even smaller is called SOM, S-O-M. SOM also has two ways to spell it out. Some people just simply call it share of the market. And it can also be spelled out as serviceable, obtainable market. It's kind of a mouthful, but actually I like this a little bit better because share of market is pretty vague. We call it market share. That's kind of sometimes misleading. But anyway, SOM is serviceable, obtainable market. Sometimes some people just refer to it as a target market, which means for a startup company, that's what you're going to focus on. So once again, target market is the focus for most entrepreneur and startup. Okay, and it is a segment that has been prioritized as the most visible or desirable one for the startup firms. So this is actually your starting place, and this is what the marketplace that you try to address based on your unique product positioning and the segment that you target. And the biggest one, TAM, is the total addressable market of the whole world, or certainly you can use the whole USA if you wish. Okay, so let's look at this side. Total revenue opportunity for particular product and services, and it's the total universe without any competitor constraint, which means that if you have no competitor, certainly you can eventually reach the revenue that you want to generate it to be equal to 10, but that's kind of wishful thinking. It's defined in the global term, which means you're talking about most likely the global market. SAM is much more realistic sizing of the market. You account for limitation of your sales channel, geographical limitation, because for instance you only want to start it in California and you only want to use the online channel, then you would only be able to take a percentage of the TAM, which would define your SAM. And if you further limit it and say we're going to just use selling this product through this channel in this particular cities, to this three major city, San Diego, Los Angeles, and San Francisco to start with, then you're further limiting that when you launch your business, and that could be your target market. So in terms of size, TAM is bigger than SAM, and SAM is usually bigger than SOM, S-O-M, or target market. Actually, this diagram here show you the proportion of the three market, TAM, SAM, SOM, or target market. And TAM is the biggest universe. SAM is how many you can reach based on your sales channel. And the SOM, or target market, for a startup is that try to identify the most likely buyer that you want to target at the beginning of running your business. I'm kind of repeating this definition of TAM, SAM, SOM because they're different definition, spelling, and therefore I want to make sure you understand when you see a different variation of spelling, you kind of know where what someone is referring to. So TAM is like everyone you wish you can reach with your product. That's the biggest market size. SAM is a segmented addressable market, or served or serviceable addressable market. It's the portion of TAM you would target. Okay, remember market segmentation, market targeting, and product positioning. This is the targeting. SOM, share of the market, or serviceable obtainable market, is a subset of the SAM that you would realistically be able to reach, and it's particularly referring to in the first few years of your startup business. That's your kind of a little bit of the so-called beachhead, which we will explain later. And there's another new term introduced here called penetrated market at present time, PM. PM actually means that you start your business, you actually has already start selling. So PM is basically I have already penetrated the market. I already generate this much revenue. That's actually very concrete evidence of your success. So if you have this information as a startup company, you already are generating revenue, you definitely want to include this, because not only this is indication of your profitability, potential profitability, and also you can use the penetrated market data to kind of estimate the SOM, SAM, and TAM to a certain extent from a little bit bottom-up approach. The market sizing information a lot of time will be used in the pitching of your startup business. This is example of Airbnb's pitching deck. You can find it here. And Airbnb is actually an example of sharing economy, which means that you can rent out a room or even a house for traveler. And Airbnb is the platform for you to do so. So they're looking at the total worldwide, for instance, hotel and other accommodation which people travel and need to stay as the TAM. So trip book worldwide is about $2 billion plus. And Airbnb initially is really target for the budget traveler, and also using the online channel. So the budget traveler is their kind of customer profile, the customer they try to target. And the online trip means online reservation of the trip, which is the marketing channel that they're going to use. So in this case, it's a smaller segment of the TAM, which end up to be about a quarter of the TAM. So it's about $532 million. Still not too bad. And trip was Airbnb. In this case, I believe it's probably a current revenue they generated so far. I don't have the concrete data to tell whether it's a current so-called SOM, serviceable obtainable market, or it's actually the so-called penetrated market, which means it's the current revenue they generated. But anyway, Airbnb put it here as a trip with Airbnb is about 10 million. Okay, most likely I think this is the current SOM, and certainly they inspired to grow that market to grab a higher percentage to reach that budget and online trips segment, which is the same. So when you try to raise money to support your startup, the investor will be very interesting to look at the market opportunity, and the market size is certainly one measurement of the market opportunity. So let's run some number. Okay, so as an example, you pitch to investors who has a target return of 10x, which means they want 10 times return on their investment. You say, well, that's too greedy. I mean, 10 times return. If I can guarantee 10 times return of any investment, I would certainly do that and sort of put my money in the bank. Remember, there's a lot of risk involved in new venture investment. So they are aware of the risk. However, since it's very risky, so they really want high return. So in case many of the investment fail, as long as one of them get 10%, 10 times return, even the other 9 fail, if everything is equal, they still at least break even. Okay, so that's the whole point why we ask for high return. So you're seeking like $250,000 investment in exchange for the investor to get 20% of your equity. So they own 20% of your company. Okay, assume you have done some market research and we find out the total available market TAM is $2 billion. And you narrow it down to the serviceable available market to be about 100 million. Okay, $100 million. So, and in that case, I think it's that's a percentage of the TAM. Okay, it's 5%. Okay, if you do the math, I believe it's the 5%. So if you grab the 5%, it is 100 million. Okay. However, as a startup company, you start small and then you scale. So the serviceable, obtainable market, you estimate that you want to reach in 2 years a 5 million revenue. And in 4 years, you will grow to 12 million. Okay, so that's your SOM. Assuming your margin, your profit margin is 25%. Remember, all the estimation of TAM, SAM, and SOM are just really based on the revenue. Okay, they're not the profit. So here, we identify, assuming you can estimate your profit margin at the beginning. Sometimes it's hard to do so. The margin is 25%. Okay, we'll use this profit margin right away. So based on your SOM times your profit margin, that's what we call EBITDA. Okay, and we'll explain what EBITDA is, which is earning before interest, tax, depreciation, and amortization. Okay, we call it EBITDA, which is really your kind of profit, okay, that you're looking for. And why we need this number? Because in investment, sometimes we look at the exit strategy. Exit strategy means that if you grow your startup to a certain point that it may be acquired by a bigger company. In that case, we want to estimate the valuation, how much your company worth. Assuming that in this case, for similar company in this particular industry sectors, that the valuation at the exit is about 8 times the EBITDA. Okay, so we can actually calculate the valuation of the company based on the EBITDA. Got it? So here I spelled it out, EBITDA, which is earnings. That's really kind of revenue before interest. Okay, taxes, depreciation, like for machinery. Sometimes it's a capital investment, but every year you can deduct depreciation out of it. And amortization, if you got a business loan and then you need to pay back there's a mortgage payment, loan payment annually, and that's amortization. Okay. So your operating, by the way, your operating profit is the operating revenue minus costs, which is cost of goods sold, and minus the operating expense. So the profit margin, which we mentioned 25%, to some extent is the net income, which is your profit, divided by the sales, which in that case, we're actually kind of using the EBITDA. Okay. So EBITDA, to some a more rigorous definition, may include not just the operating profit as we mentioned here, but also some non-operating income, because through some financial operation you may generate additional income by invest some extra cash or money that you have on hand to generate interest for your business. So the final net profit, okay, this is operating profit, non-operating income. Added together is EBITDA. So net profit is EBITDA, once again, minus interest, tax, depreciation, or amortization. So let's run the number. We know the formula. Okay, someone invests $250,000, get 20% of your company, and the industry you're in, the TAM is $2 billion. The SAM is 5% of that is $100 million. And in 2 years, we call it stage 1, your SOM, your target market, is 5 million. And at stage 2, you try to reach 12 million revenue that you want to generate. And the profit margin for your product or service is 25%. So the valuation at exit is A times the EBITDA. Okay, so we've done this before, and this is just a summary of the number that we given previously. So if 5 million in revenue in 2 years, and times the profit margin, which means that your EBITDA is actually 1.25 million. Okay. 5 million is your revenue times the profit margin is your EBITDA. Okay. So using a factor of 8, multiply the EBITDA, which will be the valuation of your company. In this case, is 10 million. So A times 1.25 million equal to $10 million. So in this case, the investor's ROI, a simple calculation. The investors will get 20% out of this valuation if we sell the company, which will be, let's say, $2.5 million. And yes, that will be $2.5 million. If we divided that by the initial investment, which is $250,000, actually that's $0.25 million. So the calculation here, that should be equal to 10 times. So basically that's the 10 times return, which is actually pretty good, better than the 8 times return, I believe. Oh, actually, that's the target return, right? What that investor was looking at. So we're right on target. Okay. And if we wait until the 4th year, end of 4th year to sell the company, and the revenue is 12 million. So the EBITDA is that 12 million times the profit margin, assuming this is still 25%. That end up to be a $3 million. And the company worth is 8 times that $3 million, which is $24 million. So investors' ROI is actually this $25 million times 20% of his share of the equity of the ownership of the company, and divided by the initial investment. And that will end up to be 19.2. A factor of about 20, which is pretty good. Let's look at the bottom-up approach. The bottom-up approach is calculated by estimating the sales or revenue of key player, key market, in order to, key player could be by product, by customer type, by region, depends on how you do this bottom-up approach, in order for you to determine the total market size. So you roll up the market participants' sales, which could be by customer, by channel, by product type, etc. So you add up the revenue of all the market participant for a specific time period, which usually is annually, to determine the market size. It is often very difficult to find product sales data, however, because that's considered a trade secret. You can kind of survey customer if you could conduct experiments, survey the customer, and find out their preference and how much they're willing to consume this type of product service you try to render, to come up with your estimation if you don't have concrete sales data from your competitor, from the existing industry. Let's do a kind of quick example, which I found from this webpage. So consider you're starting a company that you want to offer on-demand dog walking service, okay, with real-time tracking GPS, a rating system, and online ordering system. And you're going to target household with dog, and household with 2 working parents, and household with senior. Which means the household with dog, but the household actually also has 2 working parents who are really busy, the household with senior who may not be capable of walking their dog, but they do, for the health of their dog, they do want to have someone to help them to walk the dog. So assuming you got access to 3 cities data, and you collect the statistic, such as listed here in this table. Let's just use the Flemingtons as example to do some calculation. So the population, percentage population with dog, which is really this number, and divided by the total population. Okay, so it's about 16%. And the percentage population with 2 working parents or senior is really this 800 times 681 together, divided by 4,540. However, we realized through our research that the 2 working parents and household with senior, there's about 40% overlap. So we need to take out that 40% of this number that end up to be 60% left. So it's 800 plus 681, which is 1481 times 60%, and then divided by 4,540. Okay, that end up to be about 20% here. Okay, so I'm just kind of use this number to do some quick calculation to tell you how this percentage has been derived. And with this three city, we can kind of come up with kind of an average, and then we use this average in calculating the nationwide data. So with that, let's come back here. This is the population with the dog, and this is the population with 2 working parents or senior. And assuming that the number of dog per household, percentage-wise certainly is this, is independent of the number of working parents or the age of the homeowner, which including the senior. If we use the senior, that's this percentage. So we can multiply the density to find the overall percentage, which means that about 0.033% in the total population owns the dog and then has either working parents or senior. Okay, relatively small percentage. However, our base is big. It's 318 million. So if you calculate that, okay, it will end up, I think there's something wrong here. That probably should be 3.3%. Okay, there's no percentage. Okay, which is equal to 3.3%. So if you calculate, use this percentage, multiply the US population, end up that the potential target customer in terms of the number of customers is about 10 million. Okay, it's about 10 million. And assume they're willing to spend $100 per month. Okay, this $100 can come from, for instance, how many times you walk the dog for them. For instance, walking the dog 5 times a month and $20 per walk for 30 minutes or an hour, and you do the math and you come up with this $100. So if assuming that all those 100 million people willing to spend this $100 and you can reach to all of them, then your TAM is actually pretty amazing $1 billion. Okay, this is an example of kind of a bottom-up estimation to get this TAM. But certainly you may start with a small city, that will be your target market or serviceable, obtainable market. So once you reach this TAM, then you can go back down to the SAM and then to the SOM. And in your calculation, you may need to consider the market growth, assuming the market, if the market grow, and then when you try to estimate the market size down the road, you need to take the market growth or shrinking into consideration. In our example, for instance, if we consider a 10% growth year to year, if you do the math, in 5 years, the market size would be $1.6 billion. That's actually pretty good. And certainly it's a much higher number than $1 billion. And so if you tell the investor in 5 years, this will be the size of the market, you want to use this $1.6 billion. So we introduced the top-down analysis and the bottom-up analysis. The current thinking, I think, in the venture capital community, they kind of like the bottom-up analysis, particularly the bottom-up analysis based on the facts, based on some of your experiment, based on the more concrete data and statistics. Because the top-down, usually you get a macro level economic data. Okay, so the bottom-up approach, it's very company specific and with non-market specific. So you have some fundamental understanding of the market, and eventually you can help you to understand addressability in terms of the market you try to address. The top-down approach started with understanding of the macroeconomics, and based on the competitiveness or penetration, channel limitation, eventually you narrow down to the addressability of your SOM, serviceable attainable market. Okay. These two approaches are not mutually exclusive. You can start with a bottom-up analysis if the data is a little bit easier to obtain, and then compensate it with some top-down analysis if the secondary research data is obtainable. Last, we want to end it with the following, something called beachhead total available market, which really means SOM or target market. The beachhead is like in military. You want to establish the beachhead when you launch an attack from the sea. Once you establish the beachhead and with solid footing, and then you can expand. So for a startup, it's very dangerous that you start with you focus on too big the pie, okay? And because you may not be able to compete with some existing player, you want to be more focused. Certainly, if the market is too small, then you may not be interested in investors, certainly will not be interested in. So the sweet spot is big enough to get positive cash flow, which means that the market you target is big enough that you can generate the revenue to sustain your operation, which allow you to grow your operation, at least allow you to show some promise to go to venture capital firm to fund your growth strategy. Okay. So, but how do you choose your beachhead market? Oh, this came from the a book called Disciplined Entrepreneurship. Here is a chapter from it which kind of described the beachhead concept. The question you want to ask yourself is that, is the target customer well funded? And which means they have the money ready to buy your stuff. Is the target customer readily accessible to your sales force, which is the channel issue? Okay, do you have the right channel to get access to them? Does the target customer has a compelling reason to buy, whether your value proposition is very convincing or not? And can you today, with the help of the partner, deliver a whole product? This is the kind of whole product concept. You're not just selling the product, actually you're selling the total solution. Okay, that will make it even more compelling for people to buy. And you also want to look at whether there's entrenched competition that could block you. They can block you by legal maneuvering, or they can block you by launch a price war to lower their price to force you out of the marketplace. And next question is, if you win the segment, if you establish your footing in the segment, can you leverage it to enter additional segment? This is your growth strategy. Okay, if you do successfully address this segment, but for some reason you cannot leverage the segment to launch attack to other segment, then your size will be very limited, which means your business will not be very attractive to the potential investor. And the last, not the least, is the market consistent with the value, passion, and the goals of the founding team. Okay, sometimes for a startup firm, you're desperate and try to grow your market. You may venture out of your kind of focus area and out of where your really expertise is, or out of where your value proposition is best fit. So you need to be a little bit careful about expanding and growth into territory that's not really related to your product or service you try to enter. Okay, so that's all about market sizing. Thank you for watching. I'll see you next time.